Hi, and welcome to this Canvas webinar where we're going to be exploring some of the key points of how to issue tokenized managed funds on a public blockchain completely privately and with total confidentiality. I'm Daniel Lavecky. I'm the executive chairman of Canvas, and today we have a fantastic lineup in our panel to share some of their thoughts on how to achieve these goals. If I could introduce you to our panelists, let's start off with David.
Hi everyone, I'm David. I'm CEO and co-founder of Canvas. We're powering tokenized financial markets. So we provide a privacy-focused layer 2 blockchain and capital market infrastructure solutions that enable confidential, high-speed and low-cost transactions, all secured by Ethereum.
So I'm Radko, I'm the founder and CEO of Bitbond. And at Bitbond, we focus on providing tokenization technology, mostly to regulated financial institutions, but also to Web3 companies. And tokenization of funds is obviously one big topic that our clients deal with and what they use our infrastructure for.
Yeah, hi, it's Ashley Cooper here. I'm co-founder of JellyC, who is a investment manager in the digital asset space. We're based in Australia and we're looking to sort of make it easy for high net worth and wholesale investors to invest in the sector, providing a couple of strategies to do that.
So the agenda today is going to be the overview of tokenization and managed funds. We're going to talk about their relevance, the advantages and challenges of managing tokenizing managed funds. We're going to talk about the privacy considerations of tokenization, some of the options that are available and the benefits, and then Jelly will be talking about their experiences in managing not only their managed fund, but also the management company of JellyC.
Hi, I'm Radko Albrecht, and I'm the founder and CEO of Bitbond. I'll be talking about the general tokenization landscape and about some of the technical challenges and benefits of tokenizing managed funds. So let's get going and let's introduce tokenization for a bit. Tokenization means that through tokens you can represent value in a digital form. That means that you have a paperless proof of ownership. You can transfer tokens globally and instantaneously, and you can take advantage of so-called programmable payments. That means that you can conduct payment transactions in an automated way, which provides a lot of benefits throughout the life cycle of assets. Now, why is tokenization really meaningful? Well, there are some projections that say that the total value of tokenized assets will be in the ballpark of $16 trillion by the year 2030. And this will then represent about 10% of global GDP, which is a really significant number. Now, what types of assets are expected to be tokenized? Well, it's a lot of financial assets like stocks and bonds, but also private market assets and illiquid assets like real estate, loans, valuables, etc. Now, how is that going to happen? How do we achieve that $16 trillion number? Well, first of all, there are several types of token issuers like financial institutions, corporations, or small and medium-sized enterprises, as well as what we call Web3 native companies that already make use of tokens a lot today. And they are tokenizing all kinds of asset classes, financial assets, real-world assets like real estate, vintage cars, art, collectibles. And then, of course, there are also natively digital assets that have not really existed before, such as digital art. Now, there's good news and bad news when it comes to tokenization from an infrastructure standpoint. The bad news is there's a big diversity when it comes to types of companies that are creating tokens, the products and the target audiences that they have, and also the regulatory and legal environments that they operate in. And many of them already have an existing legacy tech stack. And that means that for some asset classes, there's quite some customization necessary when it comes to legal documentation, when it comes to the way payments are being processed, how investors interact with these assets, etc. But there's also good news, and that is a lot of the technological infrastructure that is tokenization specific can be standardized. Of course, there are some legacy systems. When you look at banks, for example, or larger fund issuers, then there is workflow orchestration, KYC, and customer management. And this is typically, of course, tailored for the individual situation. But when it comes to the core components of tokenization, there is 2 of them, and they can be standardized across asset classes and across issuers. The first one is what is called key custody technology. You could call it also wallet technology. And this is something where you manage pretty much like a digital vault where you safe keep the tokens. And then the second component is the tokenization technology. This is something that you need in order to configure tokens, to launch the tokens, and to manage lifecycle events. And these 2 components are so universal that they can be used in the same way across different asset classes. Of course, with different configurations, but the components, the tech components, are exactly the same. You can compare it a little bit to spreadsheet software. When you buy spreadsheet software, the software is universal enough so that you can use it for P&L planning, for example, but also for project planning or keeping track of lists of visitors to an event. So it's universal enough to give you a tool that allows you to do all of that with it. And it's a bit similar with this key custody tech and tokenization tech. Across different asset classes, it's very versatile and can be used very consistently. Now, when people think of tokenization, you would typically think of creating tokens. There are different token standards for different asset types, permissionless tokens, permissioned ones, and also so-called non-fungible tokens. But this is only the beginning of tokenization. A lot of the value from tokenization comes throughout the life cycle after the tokens have been initially created. This is during token distribution and the lifecycle management, where you can automate things like DVP, delivery versus payment, or where you can, for example, automate payments through so-called smart contracts. The benefit here is that, for example, you don't need a paying agent anymore, which would conduct these transactions in a manual way, but you can actually automate a lot of that. Now, in order to do that, you need software. We at Bitbond are the producer of a product called TokenTool. TokenTool is a tokenization piece that you can use in order to configure tokens, create them, and manage them throughout their life cycle. And you can do that through a convenient user interface or via an API. We support several token standards, and the smart contracts that we use are audited so that you can always be sure that you're using safe and secure smart contracts. And the great news is you can also use it on Canvas. And Canvas, as we will hear throughout the webinar, of course, is a protocol that is focused on privacy and that is therefore something that's very useful in the context of tokenizing managed funds. And besides supporting Canvas, there are also very versatile wallet integrations. The more bank-grade key custody solutions are Fireblocks, Metacore, and Ledger Enterprise. And all of these and many others are compatible to TokenTool out of the box. That means that you don't need any tailored API integrations or anything like that, but you can use these products and they work out of the box with each other. And how that can be interesting for the tokenization of managed funds, we are going to hear throughout the webinar. And I'm looking forward to any questions that you may have when we do the panel discussion later on. Thank you.
So I'm going to talk a bit about Canvas and our layer 2 infrastructure that's supporting tokenization in a privacy preserving manner. And so if we skip ahead to the next slide, we'll introduce what is Canvas and some of the challenges that are solved by moving to our layer 2. Next slide, please. So when we consider what are the reasons for using a layer 2 and what is the importance of delivering privacy for tokenized managed funds, regulatory compliance obligations very much lead the discussion in multiple regions around the world, particularly in Europe with GDPR and various other regulations in other markets. There's obligations on issuers and platforms to provide privacy for the transactional data. Going beyond that, in general, investors don't want their financial information to be public, and that goes across their subscription history, distributions, trade history, and redemptions. So these are normal parts of the existing financial infrastructure that delivers privacy, but have been lost when things move to a tokenized structure on a public network that doesn't deliver privacy. Next slide, please. So comparing private blockchains, which have been a traditional response to deliver privacy, we see that private blockchains provide a level of restriction, but they don't provide confidentiality because all transactional data is visible to all network members. When you look at private blockchains in terms of their interoperability, private blockchains are an isolated ecosystem, meaning that they can't interact with the rich ecosystem and rich infrastructures that are developing around the world. And so really it's a closed environment. And in terms of resilience, the private blockchains are very much size dependent, and the operators and the members have to operate all the infrastructure, where you contrast that with a public blockchain that is run as a public utility for all participants. And lastly, when you look at transaction fees on private blockchains, there has to be an allocation towards hosting costs of all of the nodes, and the fees are essentially variable within the network. Looking to Canvas Connect, where we've built a secure enclave to provide an alternative to a private blockchain, which is a layer 2 on Ethereum that delivers privacy and is secured by cryptography called zero-knowledge proofs. Zero-knowledge proofs allow for ensuring the integrity of transactions and the accuracy of transactions without showing the data within it. Importantly, our layer 2 seamlessly integrates with all other ecosystems and assets that are emerging, such as stablecoins, tokenized deposits, CBDCs, and other financial applications for use cases such as borrowing and trading. The network is highly resilient because it's based on Ethereum, and so there are no hosts and no nodes to be maintained by the members. And the transactions are low cost, and there's no hosting fees associated. So we see this as as the path forward for delivering the tokenized future without relying on private blockchains, as has been done up until recently. So to give you some insight into our network, as I touched on just now, the issues with private blockchain are that there's no public blockchains. They don't deliver privacy, they are slow, and they're expensive to use. So Canvas Connect is a secure enclave that sits on top of Ethereum and provides confidentiality, allows for KYC and AML restrictions, delivers low fixed cost transactions, and delivers very high transactions per second, so is scalable to suit modern financial applications. But importantly, the transactions that are done on Canvas Connect allow for compliant confidentiality, meaning that regulators, governments, the transactional data is available to fulfill regulatory obligations. So we're delivering privacy, but not anonymity. Now, on top of Canvas Connect, a range of different applications are built that can support a range of use cases, such as payments, exchanging of tokenized assets for another tokenized asset or for a stablecoin, lending against any tokenized asset, but as well through an API and SDK model, any application that can be built by participants in our ecosystem. So to show what the end result is of using Canvas Connect, if you look on the left-hand side, you may be familiar with the kind of view that you'd have of Etherscan. Whenever a transaction is done on the Ethereum blockchain, it's visible for everyone that has access to the Block Explorer. So there is no privacy whatsoever. Contrast with Canvas Connect, or our layer 2, where what's written to Etherscan or what's written to the network is a mathematical proof that the transaction was done with integrity. So all of the transactions that were done are secured by Ethereum, but are not directly displayed on Ethereum. And so by default, only the participants in a transaction are able to view that transactional data. This is how we deliver confidentiality whilst maintaining privacy and security and being true to the thesis of Ethereum as being a public network. So with that, I'll pass over to Ash and talk a bit about JellyC and we'll resume talking about the case study that we've done with JellyC.
Thanks, Dave, and thanks, Dan. Okay, so just a little bit of a run through through JellyC and what we're trying to solve. We've mainly come from a traditional finance background. And Michael Prendeville and myself co-founded the fund 2 years ago. We came at blockchain and crypto from a traditional finance macro top-down view to start with. Then we went and discovered blockchain. You get into the rabbit hole, as they say, and we discovered this is going to solve a lot of the world's problems. We've got a very strong team, also out of the TradFi, strong CFO, who was very senior at Standard Chartered, and Drew Bradford as the chairman, who has just left NAB Financial Markets and has also seen the light. In the sense of strategies that we're running, we initially set up the Blue Bottle Fund, and what that is a multi-strategy fund. 50% e-liquid and 50% liquid. So the 50% that's e-liquid is getting exposure through our sort of connections, both in Australia and globally, to try and find early stage and VC investments that we think will change the world. And when we dig a little deeper into that, the components are sort of gaming, DeFi, definitely heavy focus of ours, but much more on the solutions that are solving real world problems, rather than the FOMO type investment. Recently, we've also just launched the infrastructure fund, which is a node fund, essentially, running nodes on 4 tokens. And basically trying to target, we're looking for sort of capital gain on the underlying assets, while also paying a yield between sort of 5 and 10%, depending on the tokens and the weightings that we're in. And what's that's trying to solve for, I would suggest, is a more conservative entry into the market. You still get net exposure to the market, so you're long the underlying tokens, but you're also getting paid a yield at the same time. So we think that is a nice entry point for a lot of investors. Like everything in this space, there are challenges, and we're very cognizant of being very regulated. We think we want to play by the rules because we think that's the way the market goes. That's actually how we got to come and meet Canvas, because we had we run the same values. So obviously we need to be very regularly compliant. ASIC, APRA, AFSL, we are very cognizant of that. Technical, we run money as investment managers for investors, and our biggest responsibility to them is discretion and their information being private. That's both AML, KYC, also the investments we make on their behalf, and that's why we think tokenization will definitely be the way forward, and a layer 2 Canvas Connect solves those problems. And obviously operational. I think our team has all come from the traditional finance. We all see gaps in the market in regard to whether it's data storage, whether it's control of the information, the speed of settlement. These are big issues, and again, I think blockchain is here to definitely solve those problems.
Thanks for that. So as a case study, Dave, maybe if you could take us through, or Tim, if you could take us through the case study of Jelly about how they tokenized their management company and also the funds.
Sure, I'm happy to give some insight there. So we were pleased to work with Jelly on their recent equity raising round, where they expressed an interest to tokenize the fund and use the tokens as the registry and as in order to distribute shares in the management company. So when Jelly arrived to us, we looked to the various requirements, and we saw that using Bitbond, there was a way to issue tokens that represented equity in JellyC. And so through a process and a project with JellyC, we identified the requirements around the number of tokens, the various distribution amongst the subscribers, and then using Bitbond to issue the tokens via the token factory, providing that single source of truth for all the equity holders. Now, the key difference was that when it came time for distribution of the tokens, we used Canvas Connect, our layer 2. And so what that delivered is that whilst there is a on-chain record for the total amount of JellyC tokens that represent ownership in the company, the individual distribution, the individual ownership is kept private and secure. And so all of those subscriptions and the distributions for those tokens are kept confidential from layer 2 on our layer 2. And so when there is still that level of auditability, compliance, KYC, and AML, but the individual transactions are kept confidential, which was very important to JellyC and in general to fulfill regulatory obligations and also the demands from the various investors. And so now what we're seeing beyond the initial issuance of the tokens is there's further opportunities for interoperability within the Canvas Connect ecosystem into the future. So looking at opportunities for lending, borrowing, and trading, secondary trading of units that will arrive in the future. And so that's really the benefits that have been delivered through our tokenization project. And with that, I believe we're going to be stepping into some Q&A and talking a bit more about the project and about in general.
Okay, thank you very much for that, guys. What I'm going to do is I've got a couple of questions here that I'll probably start. And if you've got any questions from the audience, please feel free to send it through. Can you give us some insight into your experience with tokenization in the EU region? So Bitbond's been doing some incredible projects. Maybe if you could share with the audience today one or two of the projects that you've done in the EU that you think are indicative of where the future lies with tokenization in funds management.
Yeah, happy to do that. So first of all, there's a very broad use of tokenization already today in the EU. Part of the reason for that is that there are several jurisdictions within the EU that are very favorable from a regulatory standpoint towards tokenization. It's not yet harmonized, but there are jurisdictions like Germany, Luxembourg, Liechtenstein, Switzerland, and a few others. And some of the use cases that we've been involved with are in private market assets that are typically not structured as a fund or as a regulated product, but through the help of tokenization are being done like that. Tokenization of commodities is one big area, for example. And typically, there are cases where the commodities are then put into a fund that is tokenized in order to increase fractionalization and in order to increase secondary liquidity, which is much, much easier to achieve with tokenized products. Another area are retail structured products or certificates that in many cases are also structured from a legal standpoint as funds, here often with the goal to realize significant cost savings by removing the CSD, the Central Securities Depository, from the value chain of these products. And so these are a few examples. Most of them were in Germany and in Luxembourg, but also a few other jurisdictions.
That's really interesting. Thanks for that. Ash, can I ask you a question about some of the, can you give us some of the potential risks to investors and fund managers if privacy isn't included within your fund offering?
Yeah, for sure. Thanks, Dan. Yeah, I think it's one of, as a investment manager, I think it's probably the biggest reputational risk you have is exposing your customers' data and information, while at the same time being completely, regulated and providing enough information on the KYC and the AML side But yeah, very important, very, very important reputation. I think if there was an exposure, to the general market about, some of the either their information or, their trading through us or, the exposure through us, it would be very detrimental.
Thank you. I'm going to put a question to everyone on the panel, maybe if I could get a few ideas. What do you think are the market forces that are driving the rise of tokenization?
In our experience, if I may start, it's two things. On the one hand, cost savings are often driving decision-making processes, because especially financial institutions have an upfront cost, a change cost, a transformation cost in order to update their infrastructure. And those use cases that produce a positive business case, a positive ROI within 12 to 18 months are often preferred. So that's one big area. And then there are areas where new revenue streams can be captured by banks often, or fund issuers, where they would make asset classes accessible to investors that previously were not accessible to them. And in those cases, they want to increase their AUM and increase revenue. And typically, in our experience, these are the two main drivers behind tokenization.
Yeah, from our perspective, I think there's three things, and I think two of them have been addressed. The cost, speed, and I think the third one for us, as in trying to get more investors, is scale. This takes it, historically, we're an Australian unit trust. Historically, if we can tokenize this, it essentially becomes a global investor base, and we can scale very quickly with the right marketing.
I'd say, following on, Radko and Ash make some excellent points around the efficiency gains. I think from our perspective as well, when we look on a global basis, one of the factors that's driving tokenization of finance is the willingness for various governments around the world to adopt and enact new legislation and new frameworks, regulatory frameworks, in order to establish themselves as a leader in tokenized finance. And so when you look across the world, various regulators, various markets are racing to try and establish themselves at the forefront and be essentially the Zurich of digital finance. And so you have regions such as Germany, as Radko said earlier, but when you look at Singapore, Australia, various other regions are really pushing hard. And now in the EU in particular, we're seeing a lot of countries trying to grab that spot. And so there is a push now that we've come to a point where there's regulatory frameworks emerging that are very conducive to providing a new avenue for finance to move into a much more efficient tokenized environment that allows for a lot greater entry for both issuers and for investors as well.
Okay, thank you. We have one question from the audience. So maybe David, you can take this one. How do private transactions work? How is the data given to the right parties, such as regulators, but hidden from public users?
It's a great question. So when we use our layer 2 network in order to deliver privacy, it's called a zero knowledge rollup. And so what that means is that many transactions are bundled up and written as a single mathematical proof, or as a one transaction onto the blockchain, which contains many, many individual transactions, but is not divulging any of the individual transactional data. So many transactions can be written into a single proof, which can then be verified on Ethereum, that all those transactions which took place privately away from Ethereum were done so with integrity. So meaning that people that had the funds in order to subscribe to the fund and receive the units, that was all done with integrity. So in terms of privacy, the standard is that only participants to a transaction are able to view the transactional data. In certain circumstances, if regulators are wanting to get access to data for transactional requests, which could be for regulatory reasons, KYC and AML, that can be handled under a transactional data request, which is in line with how traditional finance works. And so that simple primitive of being able to provide transactional privacy from Ethereum, which is a public open network akin to the internet for everyone, for providing this secure enclave for transactions to take place with privacy, but still maintaining regulatory compliance and capabilities so that transactions can still maintain their compliance with global securities regulations.
Thank you. Radko, I've got another question from the audience. Are you seeing a trend at Bitbond from regulators requiring privacy or bringing it up within discussions with potential financial institutions?
We primarily noticed this discussion in the US, where I can't think of one US bank that will feel comfortable in using a public permissionless chain. We see this discussion less in Europe, although we do see it as well, but to a lesser extent for sure. However, some of the, let's say, topics that do come up in the context of privacy is when you have more active market participants, primarily investors, who do not want to have their investment strategies kind of reverse engineered from the on-chain activity. So they would often care about privacy, but more from a strategic standpoint to make sure that their investment strategies cannot be replicated easily based on publicly accessible data. So there, alternative blockchains are being discussed, like Canvas is obviously something that fits into that picture extremely well. But also the design decisions around wallets and how do you safe keep the tokens, and how can you prevent others from replicating your strategy. So these are most of the discussions that are usually coming up.
Okay. I'm seeing that we're reaching the half-hour mark, so I'm going to just ask for a closing question. Maybe if you can give me a quick chat. What's missing in regulation perspective that needs resolution for tokenization to boom?
Happy to start.
Ash, do you want to have a go at it?
Yeah, please.
Sorry, you cut out, Dan.
I'm so sorry. What's required in regulation changes? What's missing for tokenization to boom?
Well, I think it's very geographically specific. I think some regions are a long way ahead. Like in our country, I just think clarity, right? Everyone's waiting for clarity. Do I think big institutions, small institutions are going to adopt this technology? Absolutely, but they need regulatory clarity, and without that, it's going to be delayed. So I think you at Canvas are providing a great product and getting ahead of the curve, because we, in our view, this will be very significant growth. It's faster, it's cheaper, and it's scalable, and that will be adopted by all.
Who'd like to take it next? Radko.
Yeah, this is a very European view that I'm taking here, but we already have pretty good legislation and the bigger jurisdictions in Europe. What we do not have is the ability to list and trade tokenized securities on regulated exchanges. This is prevented by the so-called CSDR, the Central Securities Depository Regulation. Right now we have the so-called EU pilot regime, which allows exchanges to do that, but only within very restrictive limits. And we need to lift that, and that is one of the main missing topics when it comes to fostering secondary trading of tokenized assets, which obviously then also does impact primary markets.
Absolutely. And finally, yourself, Dave.
So having worked with regulators in Australia on a range of different projects and seeing what's emerging in the Asia Pacific region, as Ash said, we're looking for more regulatory certainty about the treatment of tokenized assets and whether they constitute financial products or not. In the context of tokenized assets, these are securities, but being managed in a framework around financial regulation, which is oftentimes 50 years old. And so to Radko's point as well, like having alternatives to incumbents for both primary issuance and secondary trading of these assets and the treatment of them under regulation is extremely important in order for this space to grow and achieve its full potential. So we're looking forward to that, both in the Asia Pacific region and the EU region as well. That will really foster this new ecosystem.
And with that, I'd like to thank all of our attendees. I hope you found it interesting and learned a little bit about how to implement privacy within the managed fund space. And if you've got any questions, either to Ash, Radko, or David, please feel free to contact us afterwards, and we're happy to make the introduction. Thanks so much for your time today, and have a good day.